Okay, so we are going to start today talking about the individual income tax return. You guys took a look, do you have your book with you? We were on what, page D11. So we're going to be working from that. We're going to have our first introduction to the individual income tax return. Each of the slideshows start out with a series of learning objectives, and then the slides that are subsequent to this will, elucidate or expound on our learning objectives. The first thing they talk about is how long have income taxes been around. In the 1800s, they were voluntary. They said that the original tax return had 4 lines on them. Now the Internal Revenue Code is 1,000,000 pages. And this is sort of an interesting story, but a couple of years ago when they were talking about tax law reform, they gave a fairly complex situation to a CPA from each state, to 50 CPAs, and said, prepare this tax return. They didn't get one single CPA that replicated another person's work. They got 50 different answers. It went all the way from the family owing $11,000 to getting $27,000 back. That's how convoluted our tax code is. So when I say to you, like, when I put a tax return out the door, I want to make sure it's correct. I know there's some, margins there. I know that less than 1% of tax returns get audited. And I know that most of them that get audited are way higher income folks than I deal with. Or it's one of those unlucky low or middle income people where they've rolled the dice. Or there's a red flag on the tax return. Like they're self-employed and their car expenses are half of their revenue, right? So I'm really careful when I review my tax returns, and you have no way of knowing what this is because you're just starting, but I'll help you with it to make sure that there's everything on it's reasonable. So in 1913, the 16th Amendment was passed, which actually allowed the federal government to tax the population. So what kinds of purposes do y'all think income taxes serve? What do you think they do? They take care of our infrastructure.
They help the government pay for the needs of the citizens.
Yeah, they sure do. They pay for the needs of the citizens. But it's not just the revenue and the disbursement to things that we need like roads and military and schools and, healthcare and things like that. It's also a tool for social and economic policy. So we use tax law to affect desirable social and economic policies. For example, you can deduct the amount you give to charities. That's socially desirable, right? So if I'm in the 30% tax bracket and I give $1,000 to the youth homes, I just saved $300 in taxes. So it really cost me $700 to give that $1,000 away. That's socially desirable, right? Credits for higher education. I'm sure any of you that are paying anything out of pocket for your own education know that you get a break, a pretty hefty break the first 2 years through the HOPE credit to help pay for your higher education. Socially desirable. Okay, economic policy. How does tax help us develop economically? Things like depreciation. It's desirable from an economic standpoint for myself as an entrepreneur to purchase pieces of equipment, to hire more people, to ramp up my manufacturing, right? So if I'm buying a $500,000 robotic line, do I want to write it off over 20 years or 2? Well, no, 2, because I get the write-off straight away, right? And then I'm going to save money straight away on my taxes. So we have capital asset depreciation policies that are very accelerated. In other words, you get to write off your assets quickly so that you get the tax benefits quickly so you can put more people to work, right? So those are examples of both social and economic policies. And I'll talk about that as we learn more. So as I said earlier, we're going to be focusing on individual tax returns. There's really 3 primary tax returns, 1040Z, 1040A, and 1040. These very first couple people, I think, will be doing one of each, the EZ and the A, but the rest of the class will be 1040s. If you, I'm down here at the bottom now, if somehow you make an error and you need to amend a tax return, you use something called a 1040X. And those are kind of a pain in the butt. And does anybody remember from the link I just showed you what the name of the Montana tax return is?
Department of Revenue.
That's the name of the agency. Yep, the MT2. And there's an MT2EZ as well.
So if you make a mistake, can you get fined as the accountant?
If you make a mistake and you've underpaid your tax, you will be penalized potentially, depending upon what the error is, and you'll for sure pay interest on the back taxes.
Your client will, or you?
Okay, if I make a mistake, I pay the penalties and the interest. The client will always pay the tax because you always owed the tax.
Oh, okay.
But I can tell you, there's not a faster way to lose a client.
That's what I was gonna say, is, make it very
Great
simple.
example, 2 years ago, I had input one of my client's son's birth dates incorrectly. I don't know if I can't even remember what I did now, if I transposed it or it doesn't matter. But he turned 17. I had his birth date input as if he was like 15 or 16. So the government kicked back that $1,000 child tax credit because they didn't have it. He was 17. He turned 17. So she gets a letter. I tell her to send it to me. I pull the file and I'm like, well, my notes say he was born in blah, blah, blah. Well, then she produced the email that said, that's not the birth date I gave you. So it was my error. So she owed $1,008 back to the federal government. Well, I don't have to pay the $1,000. They never had a right to that credit. I pay the $8, she pays the $1,000, and I lose a client. Well, that sucks. That's why you review your work over and over and over and over. Anyways. Okay. 1040EZ. In order to fill out a 1040EZ, you have to be a very simple person. You got to be single or married filing jointly. You can't be over 65, and we're going to see what that impacts in just a moment, or blind. You can't have any dependents. You got to have taxable income under 100 grand, and really, you've just got wages, salaries, or unemployment. So it's a very, very simple scenario. With that said, a lot of people fill out 1040EZs. A 1040A is basically, now you can have dependents. Now you can make over 100,000, but you can't use it if you are self-employed or if you itemize your deductions. And you don't really know what that is yet, so just bear with me. 1040 is for everybody else. I will ask you, please, by Thursday to know what all 6 of these schedules are. These are your basic schedules. Itemizing deductions, interest and dividends, self-employment income, capital gains, farm and royalties, or rent and royalties, and farm. So you should be able to absolutely tell me what, just because these are just the basic 6 schedules that we're going to use over and over. Then you've got corporate and partnership tax returns. An 1120S is for an S Corp, and 1120 regular Corp, 1065 for partnership. Honestly, because we're not doing corporations and partnerships and there's so much to learn about individuals, I'm not really going to spend any time on this. It's just kind of beyond our scope in this class. Okay, so if you look at your tax return and you look at this tax formula, I would like you on the tax return to tell me which lines you think on the tax return equate to gross income. Where are you going to find that on your tax return? That's your adjusted gross income, and that's right here, Amanda.
22.
Yes, line 22, which is the total of what lines?
7 through 21.
7 through 21. So let's look at what some of the items of gross income are. Most of us, we go straight to line 7, don't we? You get a W-2, you get some wages. Line 8A, maybe I've got some interest. Or 9A, some dividends. 10, maybe I've got a taxable refund of a state income taxes. Or I got some alimony. Or line 12, I've got some self-employment income. I've got my own business. So you can see these are all the items of gross income. When you pull out that manual recap I gave you, every single one of these items is going to be listed out. So when you start preparing your tax returns, if you have a W-2, you've got to put the gross wages in there. If you've got a Schedule C where you've got trade income, you're self-employed, you need to do some calculations to figure out what you think their net income is, and then you put that into that line. Okay? So gross income is comprised of all those things, lines 7 through 21. Then it says less deductions for AGI. Go ahead and take a look on lines 29 through 35, or 23 through 35, on some of the things the IRS lets us deduct before AGI. Some of the things you may not understand. Is there anything in there that you do know what it is? Line 28, self-employed SEP. What is that, Ross?
I don't know what SEP is, but I know what simple is.
What's a simple?
It's like a retirement.
It is. Yep, savings incentive matching plan. So they're saying, hey, if you put money into a simple, guess what you get to do with it? You get to deduct it right off the top, don't you? Anything else in there that anybody can identify with or speculate on what it is? Student loan interest. You get out of here with student loans, guess what you're going to be doing? Paying them back. You're going to get a statement at the end of every year that says, hey, of your $2,400 you paid in, $839 of it is interest. You get to take that right off the top of your tax return. Okay. Up to $2,500, yeah. And that also phases out, I might as well introduce this right now, almost everything in tax that you have a write-off for, not almost everything, but a lot of items like student loan interest, once your adjusted gross income gets to a certain level, it starts to phase out or go away. In other words, if you're making 30 grand a year and you've graduated college, you should have a right to write off that interest, right? If you get out of school and you're making 300 grand a year, they're going to phase out your ability to deduct that interest. They're saying you don't really need that deduction. You're high income. So a lot of things phase out. Okay, good. So those are all of the deductions for AGI. The most critical thing I want you to understand about these guys is everybody gets them. In other words, you don't need to itemize deductions to get them. Everybody gets deductions for AGI. You don't need to itemize to get them. So AGI, bottom number on the front page of the 1040, right? Adjusted gross income, I'm going to call that AGI. Flip to the second page, top number, same number, AGI. Next line item, well, with a number, 40. Itemized deductions or standard deduction. That's right here. It's the greater of your itemized or standard deduction. Well, what the heck is that? Let's flip to the back, thank you, jeez, the back cover. Whew, that's a tough word to remember. And if you go down to the bottom left, let's see if we can figure out what standard deductions are. In other words, what everybody gets no matter what. Okay, Mary, or Katie, sorry. You're married. So what would you and your spouse get for a standard deduction?
12,000
You certainly would. Amanda, you're head of household. In other words, you're a single parent. What would you get for a standard deduction?
Is it 9,250?
Yes, ma'am. And Ross, I believe you're single, yeah? 6,300. So right there, depending upon something called our filing status, we each have a right to a different standard deduction. Okay, but I'm confused. It says the greater of itemized or standard deduction. What's an itemized deduction?
Like a donation to a charity?
It is. Now, this is where it gets a little tricky because I can't explain everything in the first day, but let's just take a very, very, very quick peek at what our itemized deductions are. And I'm going to find that on a Schedule A. I should probably have had these marked, sorry.
It's right next to it's on B13, I believe.
Thank you. Yeah, okay, great. Itemized deductions, Schedule A, one of the things that you need to learn for Thursday. And just, I don't want to spend any time here other than I want you to scan the headings in the left column. Medical expenses, taxes you've paid, mortgage interest, gifts to charity, job expenses. Okay, we're going to obviously spend a whole chapter kind of, really dialing into this. But for now, let me just make one statement, which is, I don't think I've ever done a tax return where somebody's itemized deductions exceeded those standard deduction amounts unless they have mortgage interest. Nobody has medical expenses or giving to charity or taxes greater than 12,600 or greater than 9,250 or greater than 6,300 unless they've got mortgage interest. That's the number that bumps everybody into the itemized deductions. Okay.
And that's just if they own a house, right?
Yes.
Okay.
It's not their payments, it's the interest portion of their payments. With that all said, if I come to you and I'm doing your tax return and you're like, no, I don't own a house, but, I paid a lot in taxes and I had a lot of medical bills and I gave away a couple thousand to charity, can I just pretend like, oh, I don't need to worry about that? No, because Montana's itemized deductions their standard deductions much smaller. And so to get over that number is much smaller. So even when I know someone's not going to get federal itemized deductions, I still make sure to do a proper interview and extract all that data and get it put into the software because many times they will get Montana itemized deductions. Is everyone clear on that?
So you can have like standard deduction federal and then
Absolutely.
state.
Absolutely. So just to reiterate what Ross just said, that's completely correct. Standard for feds, itemized for state. Additionally, Paul, I'm just really trying to confuse you. For federal, there's almost no example where it would be beneficial for Katie and her husband to marry filing separately. In Montana, if they're both working, they absolutely will marry filing separately. So that's another little treat just to keep in the back of your mind. Okay, so let's see if we can get through this. So, greater of itemized or standard deduction. Now do you see the difference? Based just upon this little vignette I just painted, what's the difference between student loan interest and charitable giving based upon what you've learned so far?
You won't get anything for charitable giving, most likely under itemized, where it doesn't matter, right?
Go ahead.
Standard deduction, you still get student loan interest.
Absolutely. The difference between student loan interest and charitable giving is everybody gets student loan interest. But you only get charitable giving if you itemize. So if you don't itemize and you gave away a couple $100 this year, is that any benefit to you tax-wise?
So that's for people who like money.
It's not even so much people that make lots of money. It's you basically only itemize if you have a house. And you'll see, hopefully, you're going to be so buried in trying to get the numbers right, trying to figure out the software and da-da-da-da-da. I get all that, but hopefully you're also going to be able to start to kind of critically analyze our tax code and see who it benefits, how it works. When you hear about all the top 1% and this and that, I think you'll see over and over that play out in our tax code.
Did you often suggest to people that this is what you do next year?
That's part of what the value of being a tax preparer is, and that's a big difference between an H&R Block. If I'm charging you $300 to do your tax return, my hope is at the end of that process, I'm going to be able to say to you, you need to think about these things. Or you're getting your refund, you're getting $1,800 and everyone's like, wahoo, and I'm like, oh, no, that's going straight into your Roth or your kid's 529. So trying to kind of help you with some financial planning along, that's where I feel like I add value. Okay, so less itemized or standard, less exemptions. Well, where's that? That's line 42. Let's go back to the inside flap and see if we can figure out how much each exemption buys us. And that is at the bottom of the section on standard deductions. Does anybody see that? Yeah, it's $4,000 per person. So if you've got 3 kids and yourself, you've got $16,000 worth of exemptions. Plus your standard deduction as head of household. So 16,000 plus that 9,250. Your first $25,250 of income is non-taxable. You with me? Because your AGI minus the greater of itemized or standard minus exemption gives you your taxable income. That's the number that we take to the actual tax rates. And you're not even really required to file if you don't have positive taxable income. Okay? Tax rates. There's 2 ways to do it. There's tax tables and there's tax rates. And the tax tables are Appendix A. So if you turn to A-2, those are the tax rates. They're going to look very familiar. They look just like the payroll, the way that page A-2. So if you're single and your taxable income's $200,000, your tax equals 36,000, it's really dark in here, or 16,393 plus 0.33 of the amount over 189.3. So it's not important to spend a lot of time on this right this moment, but my point is this algebra looks just like it did in payroll. They're going to give you a flat amount and then a tax rate for everything over a certain amount. Or if you're under $100,000, you can just go to the easy peasy tables that start on page A-3. And say I had $71,500 of taxable income and I'm single. What's my tax bill? $71,500 of TI. I'm single. It's kind of dark in here. Can anybody see that? I think that we're on page A-11.
Is it 13,675?
Yeah, single. Yeah, 13,675. Oh, okay. I was like, whoa, you're way off. Okay. So obviously, if you're under $100,000, you're just going to go to the tax rate schedules and pull the easy peasy number off. Really, once you get over $100,000, then you've got to go do the math. And I wish it were that easy. Don't, again, get blown away. I always try and give as full of a picture as I can based on where we're at without overwhelming you. But it's not just that easy because different kinds of income are taxed at different rates. Have you guys ever heard of capital gains? There's a lot of hullabaloo in tax code or in tax reform about capital gains. That's when you trade stocks and bonds and real estate and gold, which, you know, let's be honest, that doesn't apply to most of us. That applies to pretty much higher income folks. That income is taxed at way lower rates. So remember when Mitt Romney released his tax returns and they showed that his tax rate was half that of his secretary and he had income of $50 million? It's because most of that income was taxed at capital gain rates, which is lower than what I pay on my little University of Montana wages. So it's not always as easy as just going to that either. Then you've got to start saying, well, how much of my income is capital gains and how much is regular income? And we'll get into all that. But again, I'm just planting little seeds to keep in the back of your mind. So you get your taxable income times the tax rate. You get your gross tax liability. So in the example I just gave you, does that mean my client has to send in $13,675? How come? Go ahead.
What they've already paid for.
Yeah, they've already paid in, I would hope, either through their W-2 withholding, right, their wages, or if you're self-employed, how do you get money to the government? Quarterly estimated payments. Or last year I had a refund coming of $4,000, but I know I owe every year, so just push that forward. Don't send me $4,000 and then I send you $4,000. Just push that forward, right? So there's a lot of ways to like prepay your taxes. The difference being then, of course, what you're due, or I'm sorry, what the IRS needs to refund you, or what you owe. Now, is it possible to owe money to the feds and have a refund coming from Montana? Sure. Vice versa? Sure. If you're a good tax planner, where should your client be at the end of the year? Even Steven. Those are when I feel totally justified in billing what I bill. I had a new client came a couple years ago, young people, and it's pretty interesting. I've had like a number of these in the last 5 years. Young people as in like late 20s, early 30s, couple kids, and they get referred from another young couple that I have. And I mean, they own a house in the University District, they own a place up the Sealy Swan. Well, they're coming to Montana with money, obviously. They've inherited. And they've got big land transactions in Georgia and Ohio and this and that. And I'm like, oh my God, because I don't have liability insurance. I don't have a partner to review my work. I do all these projections. I tell them, you need to write a check for $62,000 to the feds. And then when I do their tax return, I'm very shaky because I don't want it to come out and have it be like you've got a $50,000 refund or you owe $50,000. I want it to be like you're within $1,000 or $2,000. Then I'm like, yes. So anyways, I'll just share little stories like that as we go because that is part of, being in a tax practice.
How do you do taxes and teach at the same time?
I'm a little crazy in the spring. You'll see that if you have me in the spring. Okay, we just looked at these numbers on the back flap. Here they are. There's nothing else to say about this except you have to add something to these numbers in two situations. One is your client's over 65. The second is your client is blind. And it depends upon filing status. So I've got a single man, a lovely guy. He's a retired forester up in Alberton. And he's probably 80 now. He's not blind. What's his standard deduction? You can go ahead and just look at this data here. $1,250 if married filing joint, married filing separately or qualifying widower, and $1,550 if head of household or single. So my 80-year-old retired forester, not blind, what's his standard deduction? $7,850 is correct. Does everyone see where that comes from? I have, and you don't even really know what these filing statuses are yet, so this isn't completely fair. Head of household is if you've got a dependent living in your home that you provide more than 50% of the care for. So I've got a grandma. I've got a grandma who's got a kiddo, 2 kiddos actually, grandchildren that live with her, and she's 67. What's her standard deduction? My grandma that is raising her 2 grandkids, she's 67. What's her standard deduction?
She married?
No, single. No, single. So first off, which of these is she? She's head of household. Do I need to add a number on to get her standard deduction? Sure. Is that number 1250 or 1550? She's head of household. So 10,800, right?
So those are all if, okay.
And that's, you add that number for each thing. Let's try one more. Married couple, she's 60, he's 67 and blind. Married couple, she's 60, he's 67 and blind.
I get the 12 and 1,250.
Twice. He's 67 and blind. 12,600 plus 1250 plus 1250. 15,100. They're both 67. They're both blind. 12,600 plus 1250 plus 1250 plus 1250 plus 1250. Okay? You'll get the hang of it. Okay. Take a couple seconds here and let's regroup. Get out your magic calculators and a piece of paper. We have Juan. He's 29, 29 years old. He's single. His salary was $39,000 and he has dividends of $1,000. He has student loan interest of $2,500 and $3,000 of itemized. He claims one exemption. What's his taxable income? What's his TI? What do you guys have for AGI?
Yeah, 38,400.
Okay, so gross income's 40,000, right? 39 plus 1? Dividend
Okay,
income
yeah.
is, yep, minus 2,500, so AGI should be 37.5. Do y'all need a couple more minutes? I want you to work all the way through it. What's greater, itemized or standard? Standard. How much is his exemption? 27.2, yeah? That's the tax formula. We are going to be doing this over and over and over and over. Now, another benefit of these slides is that I write these slides for the textbook. Years and years ago, I couldn't believe the stuff that they sent with the book. So I'm like, I'm going to make my own slides, and then students loved them, and then so I sold them to the editor and said, here's what I use. So now these are used all over the country. So there's another example, like actually this isn't a good example of what I was just going to say, but a lot of times there'll be 2 or 3 examples and we'll only work through one of them together, but then you've got the ability to go back and see like another fact set and make sure that you're really getting that, okay? Thought I had done that here, but I haven't. Okay, let's continue. So, based upon what I've just told you, does everybody need to file a tax return? Why not, Jess?
If their total gross income minus their deductions, their deductions and exemptions, they don't go anything.
Right. Would you ever file if you had like negative taxable income? Why? Yeah, I worked all year. I'm a single mom. I'm going to school part-time. I worked, part-time at the mall. I made $9,000. Am I going to file? Maybe if they withheld some federal income tax from my check. Heck yeah, I want my, $622 back, right? And I'm probably a candidate for earned income credit because I've got a kiddo. If I'm between 25 and 65 and I don't have a kid, I can still get earned income credit if I'm not a full-time student. So it's not as easy of an answer, like your answer is theoretically correct, but it's not always correct because if you've got a client that comes in the situation I just said, I'm going to take one look at that and be like, heck yeah, you want to file, you want your $600 back, and you're going to get earned income credit. Okay, but generally, if your exemptions, right, $4,000 per person per year, plus the greater of your standard or itemized deductions, we just went through that, if those numbers are bigger than your income, then you're not required by law to file. Okay, now we're going to get a little trickier. If a taxpayer is claimed as a dependent on another taxpayer's return, we've got some other rules or some other numbers. Give me an example of a taxpayer who's actually earning money who might be claimed as a dependent on somebody else's tax return.
Someone with a disability.
Possibly somebody with a disability. Possibly a student. My kids were both my dependents until they were 24, out of college, right? Because we paid more than 50% of their cost of living, right? But they worked. They filed tax returns. But they were our dependents. So what did they get on their tax returns? Well, do they get their exemption? Do they get the $4,000 on their own tax return? No, I got the $4,000. Do they get a standard deduction? Yeah, and here's what it is. If a taxpayer, so I'm just going to fill in the name of my son, and he worked in San Francisco this summer after his sophomore year and made $12,000. Dylan was claimed as a dependent on Lisa and Van's tax return. Therefore, his standard deduction was the greater of $1,050 or what he earned plus $350. but never more than standard deduction. The information I just gave you is my son's W-2 was 12 grand. What was his standard deduction? And he had no other income. He had no dividends, no interest, no stocks and bonds. He did an internship, a paid internship that summer. What was his standard deduction? What was his earned income again?
Well,
Plus what?
350.
Yeah.
So 30 for,
So obviously, the first thing you do is say, what's the greater of those two numbers?
yeah,
You know, obviously that. But never more than what?
10,
Regular old standard deduction. Obviously, it's still limited to what for a single person? 6,300. Or it was 62 or 63, sorry.
63.
I don't know the numbers because they change every year. I rely on the back flap as much as you do. 63. So what was his taxable income? How much? How much was his TI then?
63.
How much was his TI? What is TI? AGI minus the greater of standard or itemized minus exemptions. That is correct. Right? AGI was 12,000, deduction 63, exemption 0 because he's my dependent. Taxable income 5,700 bucks. Yeah? Now you're getting maybe a feel for why you might want to hear some of this again and see some of this again if you've got time to re-listen to some of it. Because it does move. I mean, it's not like, oh, the numbers are incomprehensible, but it's like, wow, okay. So you've got already, you know, you've got to be dialed into this situation to even figure out someone's TI. What's their filing status? How many dependents do they have? Are they a dependent for somebody else? Right? And we don't even know the formal definition of a dependent yet. Additionally, and I'm not going to go too far into this because this is getting a little off track, but you have to file if you have any special taxes. Like, does anybody remember from payroll if you had allocated tips because you didn't report enough? Well, you've got to pay a special tax on that FICA on your tips that you didn't tell your employer about in the first place. Okay, that's an example of a special tax. Or if you have, and I'm going to call this from now on SE income. That's how I refer to self-employment income as SE income. If you've got SE income over 400 bucks, it doesn't matter whether, you know, deductions plus exemptions exceed income. You've got to file. How come? Huh? Which taxes? You don't have any income tax due. Yeah, you got to pay FICA. If you've got SE income more than 400 bucks, oh, come on. Just escape for me. I've got my tax practice, my revenue's 10, my expenses are 2. I've got SE income of 8 grand. That's it, nothing more. I'm a single mom with a kid. First off, figure out the number, and I'm not blind and I'm not over 65. First off, figure out how much I would have to earn to pay any income tax. So I'm single, one dependent. it does that over there on that piece of the board. Single with one dependent. How much would I have to earn to pay income tax? Way more than that. You've got to sum up what? What two things do you have to add together? The total of my deductions and my exemptions.
You had a household because you're single.
Yes, okay, good, yep. Yep,
And your standard deduction, 92.
okay, good. So I am gonna give the gold star to Jess on that one. I've gotta have taxable income of 17,250. I'm head of household, so my standard deduction is 9,250. I've got myself plus my kiddo, so $8,000 in exemptions. Why do I have to file a tax return? What do I have to pay on this 8,000? This is the real gold star, if anybody can come up with this. No fit though, because I'm not, right? So what's my FICA? What's the percentage?
12.4.
Close. All you got in there was Social Security, you forgot the Medicare. I know, see, it's like, payroll coming back.
I want to make a random guess.
Go ahead.
Is it,
I was gonna say there's no wrong answers, but yeah, there is. No, go ahead and guess, why not? What do you have to lose?
was it 15?
That's it, exactly. 0.062 Social Security plus 0.062 Social Security plus 0.145 Medicare plus 0.0145 Medicare, 15.3%. I've got to file a tax return anyway, even though I don't come close to having to pay any federal income tax. And I can just eyeball that and say that client's got about a $1,300 tax bill, and she's living on $8,000 with a kid. That is.
So what is the benefit of self-employment? I haven't tried to do sometimes. Yes.
The benefit is flexibility. The benefit is the harder you work, the more you make. But you pay your own taxes, you pay your own health care, you fund your own pension. You know, I love having self-employment income on the side, but I equally love knowing exactly how much money I get the first Monday of every month. That's the best of all worlds, and actually that reflects what a lot of people do in Missoula. You have a job, and then you do a little something on the side because the jobs here don't have a tendency to make everything pencil out always. Okay, here's some more examples. I don't have time to go through them, but put in your notes, I don't know which slide number we're on, 15, that you're going to want to go through slide, I thought I'd done more of these. Okay, 15 through 18 on your own. There's some more examples on who's required to file, basically what we've just been doing. Okay, filing status. There's 5 categories. You're single, you're married filing joint. You're married filing separately. You're, what's the other one we've been talking about? Head of household, or you're a qualifying widow or widower. Single's pretty straightforward. It's what you are on midnight at 12/31. You get married on 12/31, you're married. You get divorced on 12/31, you're single. There's also, okay, I'm not going to too much get into it, but unfortunately, and I've had this a couple times, your spouse like disappears. What am I? You're an abandoned spouse and you can file single. Okay. Married filing jointly again, you know, whatever you are on midnight of 12/31. If your spouse passes during the year, you file as married filing jointly in the year of death. They're beneficial tax brackets. If when your spouse dies you have a kiddo or more, for the 2 years after that, you get that qualifying widow or widower category.
Oh, that's where that qualifies.
And that again is very beneficial tax brackets. So in the year of death, you file married filing jointly. In the 2 years following, if you don't have kids, you're just single. If in the 2 years following you have kiddos, qualifying widow or widower, it's also called surviving spouse. Married filing separately, again, like I was giving the example of Katie, you're almost never going to do that. The only time I see that is when I see two older folks come together and they don't really want to merge their assets or maybe even necessarily tell each other what they have or what they make or blah, 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 because they each have their own kids and their own wills. It is always going to cost them more in taxes. Always. 110% of the time it's going to cost them more in taxes. They're doing it solely for non-tax reasons. They don't want to merge their assets or their information.
So do we go over the whole thing with the healthcare on these two?
Although, am I any sort of expert on it? Heck no. I am just learning how we are using the ACA and processing that in our tax return. Head of household, we've learned about that. They're lower rates and higher exemption, or higher standard deduction, excuse me. You can file as head of household if you are unmarried or an abandoned spouse as of 12/31. And I pay more than half of the cost of keeping up a home, a principal home, for a dependent child or other qualifying dependent relative. So my niece lives with me. My sister's a mess. She's wherever and doing whatever. I bring my niece with me. I've not adopted her. She's not my foster kid. She is my niece. And she lives with me, and I pay for her food and her activities and her clothes and blah, 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 and her shelter. Is she a qualifying dependent relative? Heck yeah. Do I get head of household if I'm single? I don't have any kids of my own. Heck yeah. Okay, now, and let me make this clear. This is my niece living in my home. Principal residence. One exception, if you pay the cost of a parent who's a dependent, they don't have to live in your home to get head of household. What am I talking about? Possibly. They need full-time care. I pay for my mom's full-time care. She doesn't live in my home. I don't have any kids. I'm single. I pay for my mama. I'm head of household even though she doesn't live with me. I pay for my great aunt that has Alzheimer's and doesn't live with me. No, I'm not head of household. Only a parent. Okay, so that's a pretty glaring exception. Okay, how many tax brackets are there? Actually, I should make you guess. This is always pretty interesting to me that people don't really have a grasp on this. In the United States, we have lots of different kinds of taxes, obviously. What is the lowest income tax bracket? Any idea?
What do you mean? Like where you saw the page? Oh, that person.
Yep. What's the highest? These are not altogether accurate numbers because with phase outs of some of the things I was telling you about, that can be higher. With, if you have a lot of investment income, that can be higher. What have I got? 1, 2, 3, 4, 5. I don't know if this is 36 or 35. These are marginal tax brackets. What do I mean by that? It's 35. Thanks, Ross. What do I mean by that? That they're marginal. And these numbers aren't right. They're super approximate. But say I'm single and I make 25 grand. My taxes, obviously, my income tax is what on that? Not a trick question.
10%.
Right? This is my taxable income, 10%, 2,500. Okay. Next example. And this before the tax bracket changes. Now I make $30,000. Do I pay 15% on that full 30? No. How does it work, Kate?
You pay 10% on the first 25.
Yes, ma'am.
And then the 15% on the remaining 5.
Everybody, if this number was 30 million, I was the CEO of Hewlett Packard, I still pay 10% on the first 25 grand. Everybody does. People seem to think when you jump to a new tax bracket that all your income's taxed at that bracket. No, it's not. It's just the marginal dollar. Get it? Marginal tax. And then let's say that the top of that bracket is 70 grand. Now I go to the next, and I make, my taxable income's 81,000. Can you write out an algebraic statement for that? If the top of the 10% bracket is 25, and the top of the 15% bracket is 70, and my taxable income is 81, you don't need to get me the number, I just want you to actually write out the algebraic formula for it. First 25 grand, same. How much of my income was in the 15% bracket?
45.
Yeah, 45 of it. Difference between 25 when I got into the bracket and 70 when I left it. So 45,000 of that is taxable at 15%. Then we changed brackets again at 70 and I made 81. My taxable income was 81. So the last 11, that is illustrating marginal tax brackets. And this is super widely misunderstood. People say, oh, I don't want to take that raise. It's going to throw me into a higher tax bracket. Well, yeah, only for those dollars, dork. You're still, it's not all being taxed at 25%. Just had this conversation with the CEO of a major news outlet in the northwest, whole northwest part of the country, and the guy's, I don't know, probably makes a couple $100,000 a year and pretty powerful business executive. And I mean, he just sat there and bald-faced said, no, that's not how it is. And I'm like, you know what? I'm just going to go back to the wine trough and leave this one alone because you're not going to, like, believe me or get it. But that's how it works. As I said earlier, none of this is true if the income isn't from earned income. What's earned income? Give me an example.
Hours work, not from like interest and dividends.
Yeah, it's like I have a job or I'm self-employed. That's earned income. What's unearned income? Yeah, Social Security is interesting. Social Security is actually taxed as earned income because it's supposedly money from your own earnings coming back. So that's kind of a weird in-between example. Interest, dividends, capital gains, buying and selling real estate, gold, antiques, blah, 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 blah. Unearned income. They may be taxed at lower rates.
Unemployment too?
Unemployment is taxed at regular rates.
It is.
It is. And interestingly enough, unemployment is non-taxable in Montana. It's taxable for the feds, but it's a subtraction on your tax return for Montana. Exemptions. I think we all know that they're $4,000 a piece. Pretty straightforward. I get one for me, my spouse gets one, we get one for each of our dependents, right? So what exactly is a dependent?
Someone who's not able to survive on their own.
Well, that's not really true because my 24-year-old could have lived on his own. We've got 6 categories. You got to go just right through these. Each one of these italicized. For a person to be your dependent, they've got to meet all of these. Dependency exemption allowed when all 6 tests met. Number 1, is it your kid, is it your child, your stepchild, adopted child, sibling, half-sibling, step-sibling, descendant of any of these? Foster children may also qualify. Does the child have the same principal place of abode as the taxpayer for more than half the year? But if your kiddo's in full-time college, they don't need to actually be in your house. They're still considered in your abode, even if they're in the dorms or wherever. Is the child under 19 or a full-time student under 24? So if you're going to have a lot of these, you need to just pull up these slides and go one by one by one through the tests. They have to meet all of them. Joint return. Your child can't be filing a joint return with somebody else. In other words, they've got to be single, pretty much. Citizenship, they've got to be a citizen or a resident of the U.S., Canada, or Mexico. And lastly, you've got to do the math to make sure you support more than half of them. In the example I gave you when my son had that great internship and made $12,000, I had to pencil out what did it cost him to live for a year and ensure that it was more than $24,000. See what I'm saying? So if his total cost of living had only been $18,000, I wouldn't have met this. I wouldn't have provided more than 50% of his support. He provided 12, I provided 6. That's not more than half. Okay? This is the first set of tests. The second set of tests is way broader. You can get your next door neighbor as a dependent. Let's just pop ahead because we're kind of running out of time. Qualifying relative. You can get a dependency exemption for a qualifying relative. If they don't meet the qualifying child test, then I want you to go to this next set of slides and go through these 5. Relationship or member of household test. A member of the household, even if they're unrelated for the entire year, might meet the relationship test. I was a big sister and big brothers and big sisters. I took my little sister into my home because her family was in crisis. I didn't adopt her. She wasn't a foster child, but I took her into my home. I fed her, I clothed her, I let her drive her car, I paid for all of her activities, I sheltered her. Yep. Did she have income in excess of $4,000? No, she was 12 years old. Well, then, never mind the car piece. Did she get more than half her support from me? Yeah, she got 100% from me. Did she file a joint return? No, she's 12. Is she a U.S. citizen? Yep. I took her on my tax return. She is my dependent. So you have to go through both these sets of tests. Do you see that? Because she wouldn't have qualified, would she have, on the first one, because she wasn't my child, stepchild, foster child. But here, even though she's completely unrelated, she meets all the qualifications. I get to take her as an exemption, $4,000.
So what if the parents try to claim her?
Then both of our tax returns are going to get kicked back. And honestly, nobody wants to hear this, but it is not worth my stinking time or money to try and hire an attorney and deal with some badass backwoods people to try and get this exemption. Do you know what I mean? I mean, I'm just going to say, you know what? Have at it. I'm not doing this for the money. I'm doing it for the love of my little sister. Yeah. Okay, we've seen these numbers. Don't forget this. Don't forget this. Okay, this is another slide I want you to go through on your own, number 29. I think I gave you 15 through 18. And now number 29. I'm going to not go through capital gains. You will not be responsible for that in this chapter. It's just, we just want to get through the basic 1040. So don't worry about the capital gains. Oh my goodness. Why do high income people hate Obamacare? Because it actually puts more taxes on them. If you earn above, or if your modified adjusted gross income is above 250 as married filing joint, or 125,000 married filing separately, or 200,000 single, you have to pay an additional 3.8% into Medicare on your net investment income and an additional 0.9% on your earned income. That takes all those tax rates that I gave you at the top of the brackets, I think the 33, 35, and 39.6, and makes them higher. Okay? The funds from that 3.8 and that 0.9 is one of the primary ways that we are backfilling or subsidizing low-income people's premiums. Okay? In socialistic terms, that's called wealth redistribution. And I will never say, particularly on tape, how I feel about policies. I will just present them from a factual standpoint, but there's a lot of people that think that it is a worthy and healthy thing for a society, and there's a lot of people that really hate it. But I will tell you it's one of the primary funders of the ACA, right? Obamacare was a name that folks that were against the Affordable Care Act gave to it as if it was sort of a derogatory term. The president's embraced it, and he himself calls it Obamacare. So that's, I mean,
So would you take the 4.1% and, or 4.7, right?
Yeah.
You just add that on to each of the brackets?
yep, above these amounts. The other thing that happened was the top capital gains rate went from 15% to 20%. So there has been impact on high-income taxpayers in the last two terms of our current president. There's definitely been impacts on high-income taxpayers. And the phase-outs, in other words, at $4 grand per person and those itemized deductions, once you hit, I can't come up with the numbers, I think it's about 154 grand if you're single and like 280 if you're married filing joint, then those numbers start to go away. That effectively pops your tax rate up too. It's so interesting because here in Missoula, Montana, I have, maybe 2 clients where those numbers are even, would even come into play. I mean, I mostly do physical therapists and roofers and carpenters, and believe me, 280 of income is not an issue. It's like more like 28 of income is the issue. But in a lot of big cities, like my son who lives in San Francisco, I mean, administrative assistants make $130 a year because that's what you need to pay somebody to pay the rent there. So what we call really high income here might not really be high income in other markets. Well done. Well done. Okay, let me shut off the recording and let you just know